All right. Hello, everybody, to another Pepperstone Live series video here. And of course, today we're talking about a very exciting topic, which is learning to combine technical indicators together. It's something that I think is so important. Confluence, building a storyline inside of the markets, understanding positioning, doing all of those types of things. It's really what breaks down markets to, better understanding. So today we'll be assessing the trading environment. We'll talk about participation in the markets. We'll talk about multiple technical indicators that you could potentially use on your charts right now to make better decisions. And of course, by the end of the session, we hope to be able to create a well-rounded trading strategy with integrating a few of these different ideas. As always, if you have questions, put them in the comment section down below and make sure to give it a thumbs up as well if you enjoy the content we put on here. Also, there was a Q&A at the end. My name is Thomas Atkinson. As always, I'm joined by Tyra Nabella. How have you been this week, Ty? Good?
Good, yes. The market has been very exciting, Tom. Welcome, everybody, and thank you for joining us again. We've got an exciting topic tonight. I'm looking forward to tonight. Love combining strategies and making the most out of the best tools that we can actually put together. So now looking forward to it.
So just before we get started, quick risk disclaimer. We'll be back in just a few seconds. So how do we build a winning trading system? And more importantly, how do we create a strategy that's going to be right for you? Are you a day trader? Are you a scalper? Are you a swing or even possibly an investor? It's all about selecting the right zone for that strategy. Today, we talk about how market participants actually get involved in markets and therefore how you need to adapt your mental mindset depending on your trading strategy. We need to start with a strong base, and obviously we need to begin adding some confluence indicators. What are some of those? We'll be talking about that at the end of the session. Tyrone, it's so important to be able to recognize your trading style, isn't it? And therefore, we need to understand the timeframes. We talk about this a lot, and that is that we need to trade liquidity, but also there are trading sessions that we maybe don't talk about enough throughout something like the Asian session, where we can take advantage of different trading strategies, more of a range-bound strategy. What type of indicators would you often recommend during something like an Asian session time?
Yeah, look, most definitely. Look, Asian times, quite often the market is going sideways. So you can really start to employ the oscillating type indicators like the stochastics, MACD to an extent, to really sort of take advantage of the ranges. You can use the average true range as well if you want to. And you've got to be mindful that you've got to set it for that session, of course, to really identify where the high and the lows of those sessions are and understanding the time of when the Asian session starts and more importantly, when it finishes, Tom, so you know when to turn off those indicators and actually, see the market really start to ramp up in London. I think understanding what your time frame is extraordinarily important, and it's something that we learned probably a little bit later than we would have liked, Tom, when we first started out. I don't know if we paid enough attention to this, but now when we look back, I think it would be very difficult to actually trade successfully without actually knowing exactly what you're in, so you can actually tune in your strategy really to that time frame. It's a big difference to your trading.
Let's just talk some pairs here before we get into the pair section. Like if we're going to trade the US session or the London session, we've got to think about the legitimate pairs that are most likely going to move during those times. Gold, a classic for the Asian session, Ty, also a classic for the London session. If we're going to look at something like, let's say, the Australian dollar, that's going to move more, of course, in the Asian session. The euro or the pound in the London session into the overlap. Such an important period for us to be focused on. Which trading pairs are best to start with? Here are some on the screen. We often talk about cross majors, things like the euro yen, pound odd, euro pound, all of those types of ones tend to provide a lot of liquidity. And of course, the major indices and also the major commodities. They're some of the best that give us the best initial technicals, whether you're a swing, whether you're a day, or of course, even an investor or scalper. So recognizing price actions, of course, that is a core base to really understanding better markets. A great way to always remember this is higher peaks and higher troughs or lower peaks and lower troughs. And really, it's just the essence. A lot of people call these types of starts, or we call it the lightning bolt, don't we, Ty? It kind of looks like Harry Potter's scar. But ultimately, it's really the beginning of markets changing trend, isn't it? And more particularly, if we see a lightning bolt doing something like this, and breaching through a previous high, that is, let's say we had a high over here, and then we make a low, and then we breach that high. So we make a lower low, and we have that higher high. That's a huge change of trend read. And you can use this on really any time frame, whether you're on a 1 minute, 5 minute, daily, even into weekly. It's so important to really think about the markets as fractal and from a top-down base, isn't it?
Yeah, I think the fact that you can actually understand the strategy and break it down, and the good thing about it is the fact that it does break down to whatever time frame you look at is what makes trading so much fun, Tom. You don't have to recreate the wheel for every chart that you open. All you have to do is understand the concept. And yeah, in my mind, and I know yours as well, when you understand price action and you understand the lightning bolts, you are 3/4 of the way to being successful. If you can understand how price action works, it's one of the most important things, not far behind risk management, of course, in terms of successful trading. When you understand price action, you have got the market by the hair.
Yeah, luckily we didn't say anything else there. Let's go have a look over here at how do large traders actually enter positions. And this is a chart that I think really shows exactly what Ty is saying there, which is we need to have that market by our edge and not by their edge. How can we do that? Well, often we have to start thinking about markets in a specific way. One of the big rules that I often consider is look for the trap before you potentially enter into a market, especially if you're a scalper or day trader. Now, why is this so important? Well, think about it this way. We have a low, we have a high, we have a lower low, and then we breach to a higher point. Really, how big market traders position is they need to create liquidity. If they take out the initial low over here, what's happens? Those lows that became buys have to become sells because, of course, to close a buy, you need to sell it back into the market. That provides liquidity for the bigger players to therefore be able to move it back up. So just think about it as this. It's always important to understand that it's all about liquidity. It's all about creation of the level. And whether you're on a 5 minute or daily chart, it's such a big thing. Price action is key. A lot of other people will consider these positions or market structure as a channeling market or a channel style pattern. That's just another way of looking at a very similar concept. Now, as you can see here in traditional pattern form, we would have our stops below the low, wouldn't we, Ty? But the most important thing here is also to look at those lows. Were these lows with wicks? Were these lows just bodies? Were these lows huge engulfings? It can make a big difference, can't it?
Most definitely. And I think this is where the concept of combining strategies really, really comes to the fore, Tom, because if you've got, as an example, I mean, if you've got a support level there, obviously at the bottom of a channel and you're looking for a reason to go up, you could have an oversold stochastic, or you could have, a moving average crossover there on a smaller time frame. But just imagine if you've got a morning star or a really sharp hammer, a big indecision candle at the bottom there, really showing you, even without the support there, that the market is very, very likely to reverse. You're looking at such a big advantage, and you can trade it with so much more confidence then, because then you know that there's so many different things going for it. Price action, as we know, is the leading indicator to beat all indicators. So when that combines with those levels of support and resistance, it's extraordinarily important. And this is what really today is all about, bringing these together to give you the overall picture.
So many different patterns, but so many concepts are built on that really great price action standpoint, that psychology of the markets. If you think about a flag, what is a flag? I always say, Ty, with the flag pattern, the flag has to fly. So a flag is meant to be a consolidation after a large move. In this case, we have an upward trend followed by consolidation, followed by obviously a hoped upward trend. If we're trying to make a prediction down here that it's going to be a breakout, we need to also ask ourselves the question, how long has it been consolidating for? Is this still a momentum-based play? Do we have a flag that can fly in the back of our yard? If it's too long and it's got a massive flag on it, Ty, it's going to take a hurricane to get that thing going on. And that could tell you that really the market's not as aggressive as it once was. And this is meant to be a continuation pattern.
Nobody wants a droopy flag, Tom. And if the tip of the flag is touching the bottom of the flagpole, then is it really a flag? It's not. Of course it's not, right? So the thing about chart patterns, and I think that we've learned this over time, and I think this is why we love them so much and why they're so powerful, is because when you understand what's actually happening inside that pattern, it's not just a flag. It's a breakout out of a consolidation zone that's actually starting to actually basically find itself in a position of buying and selling. people who have actually bought that breakout are selling their positions. People who can identify the continuation of what looks like a flagpole are actually entering their positions. And then all of a sudden the flagpole breaks. It's the same as a double bottom. The price is actually telling you what it's actually doing. It's found support. It's trying to rally higher. Once that neckline is broken, and generally those necklines are going to be broken, most patterns are broken really by a flag of some description, whether it's a 1 hour or whether it's a 15-minute chart, Tom. Most of the time, it's going to be a lightning bolt responsible for it in a time frame smaller than the pattern that you can see it on. So when you understand the patterns, it's the same even in an ascending triangle. You look at an ascending triangle there, and you can see that you've got a series of higher troughs and equal peaks. It's telling you that the market's consolidating and starting to put pressure on the upward side of that boundary. So it stands to reason that all things equal, there's a really good chance that pattern's going to break higher because the troughs are getting higher and it's getting more and more pressure on the peaks as the price aggressively starts to move up. So it's a real good combination, but it's really important to understand the patterns that you're trading because it will make a lot more sense to you.
Some more price action based methods, role reversal, a classic resistance support technique. It's one of those ones where you'll often see it in markets. But remember, the textbook, which is basically to see a resistance and a support, is a little bit different to maybe the reality. Here's an example of maybe a reality for role reversal. It's still actually pretty textbook, this one. And that is resistance over here, multiple resistances. And that is 1, 2, 3, and 4. Now, when that breaks through, it's going to be key. But notice the market actually stops before that, and it creates a level of demand. I've said this before. It's really about understanding multiple different confluence techniques, and that's a lot of what this video is about. It's really understanding that this is also a demand level. So when the market comes down to this zone, not only is it previous resistance and a sell area, but it's also a demand zone, which we know orders ended up busting up. So, of course, the way it interacts with this zone is so important. Notice also the wicks. The wicks tell us the market is excited around that level, and I often say wicks hold orders. So to kind of bring this back, some great examples of confluence in indicator form for trading strategies would include moving averages, Bollinger Band indicators, volume profiles for potentially take profit levels, RSI indicator, as Tyron mentioned before, and then, of course, pattern analysis, which we just looked at a few. Ty mentioned the ascending triangle. We also had the inverse head and shoulders, a classic one out there, Ty, one of my favorites. And then, of course, the flag. No droopy flags. And I know that was recently in America, and I can tell you, Ty, there were plenty. Well, you were too. And there were plenty of flags flying, and they certainly weren't droopy, were they?
No, they were very, very high. And the higher the flag, the more intentional the breakout of the move. And probably just as importantly, the breakout up the top. So we want high flags, high flags.
High flags, high flags. So unlocking success, Ty, something we all want to do, discover the ultimate indicator. What is the ultimate indicator? What is the one that we often see used so much from the big banks? And will it kickstart our journey? Think of it as we want to have an indicator that potentially can start off a base structure, whether you're trading single stocks, whether you're trading indices, whether you're trading a euro, US dollar, or anything like that. What can we kind of rely on as a decent start, and how can we use that technique? And it's one of our favorites, and of course, we bring it in. We'll bring in a few different indicators, though, as we cover this area. So, of course, it's going to be moving averages to get started with, and you can already probably guess which one I'm going to say because it is the mean reversion. But it's a basic yet effective strategy for us to use and build a confluence story. So let's talk moving averages for a second, Ty. There is the SMA and the EMA. We all kind of understand this pretty well, I believe. But in this case, we have two. We have the 20 SMA and the 20 EMA. What are the differences between both of these? Just quickly.
Sure. Yep. So the 20 EMA is the exponential 20 moving average, and the SMA is the 20 simple moving average. Let's explain them both. The simple moving average is basically the last. We'll use this as an example. We've got the 10 here. So basically, the last 10 candles divided by 10. That's going to give you the simple moving average. Whereas the exponential moving average adds more weight to the front end. So it still calculates based on the last 10 periods. But what it's doing is giving far more weight to the most recent candles. Okay, so what that means is that the most recent movement is actually giving that moving average more weight, which means that it's technically, and not technically, it is actually faster than the simple moving average. Now, that can work for you or against you. Sometimes being a little bit too quick, Tom, it can be a bit of a negative because it can give you a couple of false breakouts. But for the most part, for the shorter time frames, the for the 20 and the 50 in particular, we always use the EMA because we feel that the risk of a slightly early entry or a false signal outweighs the slower simple moving average on those two. So really the 20 and the 50 EMAs are the ones we absolutely love. But realistically, you show me a trade that's broken out and I'll take you to a time frame where you can enter on pullbacks of the 20 moving average on a time frame below. You will find one. You will absolutely find one. We do it all day, every day in our live streams. So I think it's really, really important to actually start at a base where you know there will be some sort of a trade as long as there is market action, Tom. And I think the 20 moving average, the EMA in particular, is the perfect starting point.
Yeah, so 20 is a great one. If we talk about moving averages, though, my favorite way of using them is a method that we're going to use to build a confluence right now. And the first one here is moving averages for momentum-based strategies. It's going to be for dynamic support or dynamic resistance. Now, you'll notice on this chart here, we have a couple of bounces. And I like to call it the 1, 2, 3. We've talked about it a few times. And my favorite concept here is to say the 1, 2, 3. Here's the 1. Here's the 2. Okay, well, it's probably a self-fulfilling prophecy a little bit at this point. Obviously, we want to build confluence with it. Here's the 3. Here's the 4. Here's the 5. And obviously, a failure happens at the 5. But imagine if you recognize the pattern at 1 and 2, and then the third one, the fourth one, the fifth one. This can go on for maybe 20. I've seen it on stocks like such as Apple, which we'll bring up in just a second, go for quite a long period of time. Here's a classic, the daily S&P 500, and you can see here the 1, the 2. So there's the actual ones really here. The 2, new higher high. So the key is always to have a higher high. Remember, we talked about price action all the time, higher highs and higher lows, higher highs and higher lows, etc., or lower lows, lower highs. There's the 2, there's the 3, there's the 4, and then we get a failure at 5. But Ty, it's more interesting than this, isn't it? Because if it breaks underneath and that was a clear dynamic support, it could become dynamic resistance in the future, couldn't it? And that actually tends to happen more times than not.
Most definitely. And once that moving average starts to turn with price and actually starts to push price down, it begins a whole new party, which is the downtrend. And really, the downtrend pullbacks to the moving average are just as effective as the uptrend. Sometimes more so, Tom, because the market comes down in an elevator sometimes, as we all know. And the reactions off the resistance are actually even sharper. So you actually get moves that are even quicker. You're in and out actually considerably more. You look at that example there on Apple even, and we saw that on the S&P 500. Like that is just trading 101. And I think what probably the highlight of this is probably what we're trying to isolate is if this is your base, and this is what we're talking about, having a 20 moving average is your base strategy to begin with, and you follow the trend and trade pullbacks too in that direction. Yeah, look at the starting point that you're giving yourself. Like it's just an amazing base. When you start factoring in things like I've seen, I think it was on the NAS. I'm not sure if you can bring up the NAS at short notice, but maybe people can go look at it. There was an amazing pullback to a 20 moving average that actually had a morning star right on the 20 moving average on a daily. And it was like, wow. It was very, very exciting. We noticed that, I think it was on the daily, probably putting you on the spot here, just throwing it out there for you. There it is there. The last touch of the 20 moving average, if we can blow that up, look at that wick. Just down a bit more there. Look at that wick. Like that is just a big rejection off the 20 moving average at a roll reversal zone. If you go to the left of the chart, you'll see roll reversals everywhere. And that was just a dynamic lift off that point. And you can see what happened after that. But it gave us many opportunities. But that was one that actually coincided with a chart pattern that was actually very, very powerful. So even price action traders who are just looking at price action alone would have taken that trade, let alone the fact that it was actually resting on a 20 moving average. And not to mention the fact that the 20 moving average has held this up for months and months and months, nearly the whole year actually. So when you combine price action with the 20 moving average, that's just one combination, add roll reversal into the mix, and you got 3 very, very good reasons to be looking at that trade with a very, very positive outlook.
Well, let's talk building together a few different strategies. I'll use the euro US dollar just as an example here, because what I want to do is I want to build out a confluence system. How can we do this? Now, we're going to use a daily here, but of course, this could work on a 5-minute, could work on an hour, could work on a 4-hour. It's about building a logical scenario. The first thing I want to say is that, of course, we are in a downtrend. We can see a series of lower lows and lower highs. And we've got a 20 moving average on here, which actually seems to have been pretty well respected many times. You can see over on the left-hand side here, respect, respect as it breaks through, respect as dynamic support, breaks below, respect as dynamic resistance, respect as dynamic resistance. Now, this is just an example of being able to recognize that pattern. And you can see even down here, it recognizes that 20 moving average. And we often get close to it and we see sells, and we get close to it and we see sells. Now, because this is a downward trend, and then it's such a clear one, we have this trend line that we've put in. Now, this is just building confluence with a price action based stand concept, which is trend lines. Now, trend lines can be a bit subjective, but this one's got a beautiful bottom and top end tie. And as it breaks through, it gives us the opportunity to say, well, we've seen this 20 so many times respected or close to. What if it then pulls back down to the 20 and we see something like that nice wick rejection, like you were mentioning, plus the volumes down here in the low? Could we be starting to build out a strategy here?
Absolutely. And what's quite amazing about this euro is not only the fact that it did everything from a technical standpoint that you could only hope for. If you're writing a book on technical analysis, this would be your example, Tom. Realistically, most of the time when you are trading in the direction of the trend using 20 as the selling point, most of the time, the last trade may be a losing trade because you don't get a lot of notice when it actually does break through. But the beautiful thing about what the euro did there was it actually failed to make a new low before it actually tested the moving average. So as you can see there, it followed it all the way down, but then it actually failed to make a new low on the after the last touch. So you were on high alert, even at that 20 moving average. When it went back up at that 20 moving average, you were on high alert not to be looking at a sell there because it failed to make a new low. So it gave you basically a week's notice that it was not going to actually fulfill its destiny and continue to sell. And then it gave us the famed lightning bolt that we always talk about. So not only did it actually give us warning that the trend was over, but it also gave us a lightning bolt to break through at the point that you're talking about, and then off it went. So it was it doesn't always work that way, though. You don't always get that notice. A lot of the time, the break of the 20 moving average will cost you on the last one. But most of the time, a good trader would have maybe taken 6 or 7 opportunities sometimes before you actually lose one. But that one gave us notice. We would never have lost on that one because there was no entry signal. It never made a new low. And when you look back to the left of the chart, you can see that we're already in a high support level. You can see that previously we had very, very strong touches there. So it stands to reason that when price gets to that level again, and we know it's a very strong level, there's a really, really good chance that there's going to be orders there to protect it. And when that pattern forms, there's an extraordinarily high chance that it's going to go up. All you need is the momentum to shift and the party's on.
To put ourselves in the position of a larger, big institutional trader, do they have stop losses? The short answer is generally no. They have positional movements. So what happens here? Tyron mentioned the support or the demand zone, and then we see the market actually break to a new low. Now, at that point, do we know anything? No, the trend's still down. It's still underneath the 20 moving average, but then it makes the shift towards the buy side, breaks that 20 moving average, makes the higher high that Tyron's and the higher low Tyron's talking about. By being patient and reacting to that, we could have potentially a much better positional entry in our standpoint. And this is just using a 20 as a base and price action as a guide. And of course, that's the beginning of any good confluence system. It's about really understanding price action with a couple of indicators. A few others that you could use as example would be things like Bollinger, which is going to give you a 20 in the middle. We could also use things like MACD. We could use RSI. We could even use a volume profile. So quite a lot of different indicators certainly on the plate or on the table for this type of system, and something we would always be looking at. All right, so can we unleash our trading potential with game-changing indicators, Ty? Are there any superior ones that give us the level of discovery which we need to be able to see where the biggest players actually have their orders? So there's always been a couple of indicators that I would say are some of my favorites in the market. One of them is relatively new, but it's based on, of course, a very logical concept. And the other one is incredibly old and goes all the way back to, I guess, the beginning of everything, the beginning of civilization, as we like to think of it. So that's Fibonacci. And of course, we'll be talking about that today. We're also going to be taking a look at how Fibonacci works and, of course, whether we want to be using another indicator potentially with Fib. So Fib numbers, Ty, they were created a while ago, weren't they? But I still say they were created by Egyptians back in the day. That's my personal opinion. But anyway, what are the books tell us, Ty?
They were actually created by aliens that that actually were before the Egyptians, who built the pyramids, and the Egyptians claim to the Fibonacci numbers. So actually, they're from another world, and they've been around longer than civilization. So we should respect them because they actually do play a very major role in the markets, and for a very, very logical reason, which we'll look at some examples of, because really all they are is explaining to us visually where the pullbacks are and how deep they are to the relative move that you're actually doing. So let's talk about the golden ratio first. The golden ratio is 1.618. And really, Fibonacci numbers are numbers that effectively build onto themselves all the way to, it's exponential, actually. There is no end point on these. But every Fibonacci number is 1.618 times the previous number, and that's how the sequence works. So that's why, as you can see in the example that we've got, it goes to 1, 2, 3, 5, 8, and so on and so forth to infinity, effectively. And every number is 1.618 greater than the previous number. So the 1.618 is referred to as the golden ratio. So when we look at it from a charting perspective, the 61.8 level is what we would consider the golden level when you're looking at pullback. So, and what that's effectively saying is, the easiest way to read a Fibonacci chart is actually to say, yes, those numbers are important, but what those numbers are actually a percentage of the actual move. So if you look at the swing low that we've drawn there, the swing low to the swing high, let's call that 0 to 100. All those pullbacks are effectively the percentage of that move. So a 61.8 is a 61.8% move of the swing low to the swing high. The 50% is the halfway mark. 38.2 is obviously 2 steps forward, 1 step back, one of our favorites. 23.6 is a very aggressive one. And obviously the 100% pullback is a pullback all the way to the very bottom. And you're going to see that play out in a double bottom pattern or a double top pattern if you're looking at it the other way. So the easiest way to read Fibonacci, you don't have to be a mathematician like Mr. Fibonacci was. All you need to do is just imagine the line that you're drawing being as a value to 100, and the Fibonacci pullbacks are the retracement percentages of that particular level.
So there's a couple of rules we put through, Ty, and of course, rule number 1, only ever use some key levels here: 23.6, 38.2, 50, 61.8, 75. We think they're some of the best out there. If you were to say which one's the best, we'll go through that in a second. I've got probably a different opinion, but Ty and I have different ones, and that's the beauty of trading. We have different levels that we tend to like. Rule number 2, the retracement level being considered as support must have at least one other form of support or resistance backing it up. Confluence. We need to build a strategy with Fibonacci with other techniques, not just one technique. That's not going to really play it out. So which fibs do we actually use? Well, I would say we definitely use the golden pocket, which is basically 61.8 to the 66 Garn number. And what about the 38.2, Ty? You love that one, don't you, very much? Great swing one.
The 38.2 is my favorite swing Fibonacci number because that doesn't take away any momentum from a market move. So when we're talking about a lightning bolt, the best lightning bolts, they're not all lightning bolts are equal, Tom. Some of the best lightning bolts actually have the higher trough at about a 38.2% pullback of the initial move, the first lightning strike. So what that is essentially saying is that the market isn't pulling back very far, so it's not really losing much momentum, okay? So the further it pulls back, the more momentum it's actually losing. Even though it may still be going in the same direction, it's losing a reasonable amount of momentum on its way up. So what we're looking for, a 38.2 pullback, is telling us that it's almost like the 2 steps forward, 1 step back approach, okay? So that's one of our favorites. So if you look at it from the standpoint of 2 steps forward, 1 step back, you're not pulling back too far to the point where you can see. That's a perfect example. You can see that we've got a move. That's the 38.2 pullback roughly at the 20 moving average. Confluence, as what we're talking about. 20 moving average is backing up that level and then off. Look at the excessive move that moves straight after. It's a really big explosive move because the momentum hasn't been halted. Okay, you can see very clear. You can make a case for a pennant there. You've also got a pennant there and a Fibonacci pullback and a 20 moving average. That is a truly really unique, and this is only recent too. We're not just pulling these out of the sky. This is the euro has been a technical dream, Tom, for several months now, actually. But they're the things that you're looking for. You're not just looking for a Fibonacci number. You need things to back up that number. But that's why I love the 38.2 so much, because it doesn't halt momentum.
Yeah, you often get like a lot of really aggressive trends like this that'll come down to like 23.6 and 38.2 numbers. So when you get in those aggressive trends, when you're recognizing maybe a 20 moving average or something that's bouncing off, and you're thinking, oh, there's a 20 moving average sitting there, 38.2 sitting there. What a beautiful confluence zone. Multiple methods. What about if we have support like here becoming resistance? We've got a 38.2. If that had gone just a little bit higher, and I know it didn't in this case, but just as an example, if this level had been hit and this market had come up here, it would have been a great trade. One of those ones that you rate much, much, much higher than the rest, because of course you're going to have the 20 roll reversal, your supply becoming, a key point there as well. Downward trend line, so many things. Let's mention one of my favorites, which is of course the 61.8. I'm going to use another recent example here, which is basically a really excellent level from the perspective of change of trend. So we basically saw here a low, and then we kind of breached that 20 moving average. And at that point, you're thinking, okay, what could happen next? And it pulls back and it comes into the golden pocket, which is the 61.8 to 66 number. Then we see, some ramps, and of course the 20 moving average being acted on again. Great level for Fib, and certainly one of those zones that we want to build the confluence together with. So I'm loving the Fib in that area. Another thing that you could do on these charts, Ty, is always to use things like fixed range volume profiles or something like that. You can use that as you're, going over a zone to recognize where market participants are. And it's probably one of the most hidden indicators that not enough people are using out there at this stage, but probably one of our favorites and something we've honed our skills in on quite a lot over the last couple of years. It shows us where the positions are placed. What is the most traded zone? Well, as it turns out, it's that price right there, 1.05632. Notice where the market came back to after that level, 1.05632. Big buy, off to the races. It's a great way of understanding market positioning better with kind of like a cheat technique in some ways.
Absolutely. And volume profile is relatively new to, I guess, our trading arsenal, because it hasn't been available in all of the platforms that we've been able to use. But now that it's there, it gives you dynamic information on where the buyers and the sellers really are, and those levels. It really gives you a lot of confidence at those levels, doesn't it, Tom? When everything basically overlays itself, it's an amazing tool, and certainly one that we encourage you to look at. We've done videos just on it, so don't be too daunted by the fact that it looks difficult. You can go back through the library, and there are many videos that we've done that explain it in great detail on how to use it and where to apply it.
All right. Well, let's hand it over now to questions and answers. And we've got a couple of questions coming through, and I've actually got them up here.
Do.
Yes. So I'll answer just this one because I think it's probably for me here, and then we'll go over to some of the others, Ty, if that's all right. One of them is basically, seems like your focus is only on TA. Can you share how you include fundamental analysis in your trading as well? So it depends on what type of instrument you're trading. Now, are you trading currencies? Are you trading, a stock or indices or anything like that? You will use fundamental analysis with stock, in particular single stocks. Let's say you want to buy some shares of Apple. Of course, you would like to understand some things. A good kind of rule of thumb when it comes to fundamental analysis is to realize that algorithms out there can crunch numbers much faster than you. So if you're thinking about what's a good one to maybe start to consider, it's something like forward PE. What's the average 5-year forward PE for that stock? Is it one standard deviation above or below? That can be something that you're looking at. Now, going into spreadsheets and understanding forward peg and those types of things is going to be a little bit more difficult because it's quite time intensive. So I like to use simple, basic things. Is the stock cheap or expensive based on the average over time, and also based on growth metrics? You can easily check those things, and often you can actually use the streets concepts on that as well, Ty, can't you? So you can get reports out there that tell you whether there's buy ratings or sell ratings. When you combine all of them together, they'll often come up with those levels. But fundamental analysis can be quite tough. And I'm just going to show this, and this is why I want to take this question. It's because the Australian dollar, we know that this week they raised the rates. So obviously 25 basis points, and it was mostly expected. I think it was about 77% chance of raised rates. So the market ramped into that, and then suddenly the rates were raised and it was sold off. Now, conceptually, as a fundamental analyst, you'd be like, oh, it should go up. But the exact opposite occurred and it sold off. And that's because this was a buy the rumor and sell the fact into liquidity. And that's why sometimes we say instrument is so important, don't we, Ty? Because technical analysis was getting you in early here, getting you towards a resistance or a supply zone. And the fundamentals in this case actually punished you because you would have thought instantly, oh, I should be buying based on the interest rate decision uptick. That didn't happen. So this can be somewhere you get trapped.
Most definitely. And Avery, I know you say you don't mean stocks, you say FX and CFDs, but you've got to remember that the majority of CFDs
this is FX.
Yeah, and CFDs, the majority of CFDs are actually based on stock. They're an underlying representation of what the stock is actually doing. The problem with fundamental analysis for, say, a webinar of today's description is that it's not going to do a lot of good if you're a day trader or if you're a scalper. Fundamental analysis can be a little bit slow. We absolutely use it, and we've done many webinars and videos on it. So definitely check out the library, and you'll see how we do combine fundamental analysis with TA. But it's horses for courses. If you're doing only very short-term trading, it's going to be difficult to implement fundamental analysis. That's actually going to give you an edge, right? What we're looking for here is giving you an edge in the market for entry and exit zones in fast-moving markets. Fundamental analysis can certainly help you, but that's it's a bigger picture view. So it's going to do you a lot more good in that regard. Virgilio, I hope I've said that right. You have called us sir, so you can ask us whatever question you like. Tom loves being called sir. He says, based on our trading experience, how many times does an ask price or a bid price touch your preferred entry price before you actually press the buy or sell button? That's a good question. And really what we do in that regard is we actually set zones rather than a particular price, because what you'll find is the market's not a perfect moving mechanism. It does have idiosyncrasies that can cause it to fluctuate very quickly and sometimes slower than you would like. So when we talk about a level, we're really talking about a zone more than we're talking about a particular number. So what we're looking for is effectively, so say on the euro, we were looking at that level, let's call it 105. We were looking at buying at the 105 level. We wouldn't just be waiting to hit the button on 105. We'd be setting a zone maybe between 104.80 and 105.20 and looking for the small sharp reversal inside that zone. And the trigger point may not be the 105 exactly. The trigger point is actually when price breaks through a certain high that we're trying to take out. So whatever number that is the number that we press the button on. We don't look at spreads too much in terms of, is it too small or is it too wide? Because really the entry point's the entry point. If the spread is worrying you, maybe your take profits and your stop losses are a little bit too close to the entry point, because really when you're trading in the Pepperstone platform and in the Pepperstone ecosystem, especially in the majors, the spreads are the most competitive in the world. They're very sharp and generally very close. So I very rarely look at the spreads, to be honest, Tom. I mean, I know you're the same. Generally speaking, we don't look for one particular price. It's a level. And when that level goes, then we take it out. So think about a level as a zone rather than a particular price is probably the best answer to that one. And you're going to get a little bit more. You're going to get more entries, that's for sure. and you're not going to miss as much of a run, because sometimes waiting for a particular price can be very punishing when it doesn't get there, Tom.
Yeah, I think it's really important to understand as well when it comes to trading any of these things. Price action is ultimately your key to activation, as Ty said. Position. So position is going to be a big thing, and spread is not necessarily going to completely change or make it big. No. But answering a spread question, Ty, Ant has a question. He says, how often does spread get super wide? It does depend a little bit on the liquidity of the pair that you're trading. If you're trading like an exotic, a lot of people sometimes get stuck in. I remember one that famously got me, which I think was the Mexican peso, Ty, when I first started trading 15 years ago, 16 years ago, whenever it is now. And basically, that one had a big spread. I remember spreads were much wider back then. Do remember news events can widen things. They create illiquidity events, particularly some red news. Get your economic calendars out and be aware of those. Some classic ones. Non-farm payrolls, CPI.
CPI now is becoming really important. When the Fed is announcing a rate decision, and the spreads actually widen while they're talking, while the pupper's talking, you see the spreads actually start to go a little bit crazy. So you want to look at news-related events are possible to trade, but you've got to trade them with caution, because if you're going to see a spread widening event, that's when it's going to happen, when the market is extraordinarily volatile. 32 is a big spread though. Just so it'd be interesting to see if that was right in the middle of a news event. It would not surprise me, Tom, if that was a non-farm payroll release. We've seen it happen.
Yeah.
It can get very wide.
Yeah, it sounds like it could be, or at least a Jerome Powell. Here's an answer from Kim saying, set your zones and set your alerts, and then look for the reactions around those alerts. Yes, patience will pay off here. Another one from Monetary Flow. Are you able to show an example on copper or iron ore? We'll actually put copper up before. So here's copper. It's very similar to actually the other one before, and it shows you, again, 20 moving average in action. You can see here you get like a few touches to the 20, then all of a sudden you breach that 20 through, and then you take a higher high. At that point, even the point that we're at right now, you're seeing downward trend line being breached. You've seen switch of trend being potentially going through. So if you're looking at this as a bull or a bear, you're going to start saying, well, maybe this is turning a little bit more bullish from a technical standpoint. Is this a key demand? Yes, it is. It's a key support or demand zone. Have we broken through a key zone? I would argue, yes, we have. So therefore, we would break down to smaller timeframes. And what this can do is it can also give you a little bit of bias, and that bias could be based on higher timeframe price action. Maybe you're on the 3-minute, 5-minute chart, and you're looking more predominantly towards buys and sells after you see whatever your particular trigger points are. So it's just an example of bringing together some of the strategies we've discussed today.
Yep, absolutely. Avery says, when we do our price analysis, are we suggesting to leverage or avoid economic news events for trading? Look, news is an interesting one. I think people always try it at the start, Tom, because they think it's exciting, but it's absolutely fraught with danger. It really is. Wide spreads. Like Tom said earlier, sometimes even a good result is a bad result for the market. It can be very, very difficult to predict. I personally, and I know Tom does the same, avoids trading around the news, because there are so many good opportunities to trade with technical analysis. Like, you get so many good setups at different times. It's far easier to avoid the news than it is to trade it, I've always found. And we've had some extraordinary success trading the news, but it was really lucky more than actually good technical analysis. That was very, very early on in our careers. But I think even we actually learned from that, that we realized very quickly that it's actually a flip of the coin, and that's not how technical analysis works. Technical analysis actually gives you an edge, and that edge is best served when you're avoiding wild swings in the market, and that's what economic news does bring. So my personal trading does avoid news, yes.
Yeah, I find that you actually get better entries straight after the news. Markets will come to grab liquidity, and you'll actually find that a lot of your prices you were hoping on do get reached more often than not, often during these news events.
Yep.
All right. The last question here is whether we like to trade, or when we trade odd or yen pairs, what time of day do you usually trade those? Well, look, often odd will move during the Asian session in the morning. You'd look around Sydney Open to basically Japan Open, Tokyo Open. That would be a good time. Another one would be, of course, the London Open, even though, well, actually the yen would be more like towards the US Open. I find that US dollar yen actually moves better in the US Open. So if you're going to trade those pairs, that would be a good one. Odd Asia into maybe London. I find it slows down a lot in the US session. I think you would agree, Ty, with that. But yeah, the euro and the pound would be better at that time. US dollar yen tends to be all day, but I would say Asia and US would be the times for US dollar yen.
Yeah, absolutely. And just on that, Avery, not all economic news is as important as each other. Yes, there's news nearly every day, but there are headline news. You want to avoid the red news. The red news is probably the one you really want to avoid. The market is robust enough these days to be able to handle the brown and the yellow, which is probably what you're referring to. The red news for us is a no-go zone, though, because that means...
Well, here's proof in the pudding, Ty. Just oh no, Abhijit said here, absolutely avoid news. That's in the comment section. There you go.
Yeah. Red news in particular. The red news is the one you want to, definitely avoid. Just quickly, the last one from Adam. Have we ever seen legit bots automated trading? Automated trading certainly works, but, only when you understand the strategy. And basically what you're replicating is what you already know the market will do. What we found, if there's any really, really good bots, they're not going to be available for sale, and they're certainly not going to be sold for $39. So you want to be you want to be avoiding people who are selling them. Generally, I would be wary of that. Very, very wary. Do very robust back testing and trade it in demo accounts first before you put live money on it. They are precarious, and you want to be really, really careful. Automated trading absolutely can work for you, and there's no question about that. But you need to be the mastermind behind it. You need to understand exactly what that automation is doing, why, and that will give you the true edge, because then it will take the decision-making process out of your hands and basically give it to the automation to do for you. So it absolutely works, but you need to be the master. Absolutely.
Yeah, you really do. Unfortunately, markets modify over time slightly, and you've got to be able to therefore like hone them in. So you need to understand the system.
If you don't know why it's doing what it's doing, you'll never be able to adjust it. You won't be able to adjust
or
it
scale it.
Change.
You know, grid systems in particular, very dangerous system that kills people's accounts, and it's very, very dangerous. It looks great on a chart though until it doesn't. All right. Well, thank you so much for joining us this week. If you enjoyed these, of course, sessions, make sure to subscribe and make sure to give it a thumbs up. It really does help us out. So thumbs up right now if you can. And we'll see you again next Wednesday at the same time for another session where we go through markets from a TA-based standpoint. Remember, if you have questions in between now and then, put them in the comments down below. But more importantly, join us next week, ask them live, and of course, we'll answer them. Thank you so much. Bye for now.
Thanks, everybody. See ya.